Tonight we are delighted to have with us as our speaker Dr. Alexander Wissner-Gross of the MIT Media Laboratory. The world of financial trading has changed. From human-initiated trades in the financial markets to substantial numbers of trades being initiated by automated operations. The world has simply changed. And tonight we will hear about how these trades never stop. They cross national boundaries, international boundaries, and at a very high frequency. The world has simply changed. We will be hearing about these new changes in the financial markets and the use of quantitative finance, which incentivizes the modeling of human group behavior to efficiently allocate capital. We'll hear tonight about QF and explore the potential role of high-frequency financial trading as a catalyst for the emergence of artificial intelligence. Dr. Wissner-Gross earned his BS in physics, electrical engineering, and mathematics from the MIT School of Engineering, and a PhD in physics from Harvard University. Following his PhD, he was named as a Ziff Fellow in Computer Science at Harvard. He is an academic author, an author in the popular scientific press. He is an inventor, an advisor to technology companies, and currently serves as a research associate at the MIT Media Laboratory. Dr. Wissner-Gross.
Can everyone hear me? Can you hear me now? Great. Well, thank you all for having me. It's a pleasure to be here. And I'm going to give you, I think, some pretty interesting recent thoughts as to the direction that the financial industry is going in and its intersection with artificial intelligence. So the title of my talk is Trading at the Speed of Light. Now, the overall theme of my work deals with the intersection of the physical and digital worlds. And I think in sort of exploring that interface, one of the most interesting ways of trying to decide how to focus attention is to focus on where scarce human labor and capital is actually being allocated. In the financial industry, it's one of the largest industries and one of the largest right now areas where human, and in particular, physically oriented human labor is being allocated is an interesting place to start. But let me back up and talk about artificial intelligence. So tonight's talk, I'll think about two questions. The first is, what would the first superhuman artificial intelligence look like? This is a question that is on the minds of many computer scientists these days. We're, I think, well past the artificial intelligence winter, the so-called AI winter of the 80s and 90s, when a lot of the early promises of AI failed to deliver, funding was cut. We're now past that, and AI for the first time is really starting to deliver consumer side on the enterprise side. And it's reasonable again, and it's even politically correct to start to ask, what will superhuman AI look like? The second question that I'll try to address here is, what can we learn from our answer to the first question about ways of managing the development of AI? And as I think you'll see, presence of this talk in Washington, D.C. is perhaps quite apropos to that question. Can you regulate AI? So let's first think about where these sorts of advanced and general artificial intelligences might come from. I would argue that the two likeliest arenas, the two most incentivized arenas, are quantitative advertising and quantitative finance. So quantitative advertising, you all interact with whenever you surf the web, when you do a search on a search engine, when you visit a third party, so a non-search website, and you see display ads on that website. Those ads are being targeted to you based on computer models of how you think and how you buy and how you behave. Similarly, if you are in the financial industry and you're an active trader, you very rapidly discover that there are many non-human intelligences not necessarily human-level intelligences, but many non-human intelligences that are also trading on that market. Now, there's an interesting sort of duality, I think, between advertising and finance, in the sense that the perfect advertising system would have a complete model of a human mind so that it could reverse engineer your thoughts and figure out how to sell you something. Similarly, the perfect financial system would have a perfect model of large-scale human group behavior so that it could efficiently allocate capital as needed before the human group even realizes that capital needs to be allocated before the demand exists. So in that sense, both advertising as well as finance are perhaps the two most incentivized fields because there's a strong financial demand to model human minds for the development of superhuman intelligence. That said, the financial industry is significantly larger. The financial opportunity is significantly larger, and I'm sure many of you, either directly or indirectly, are aware that the markets are now dominated by robots. This is robots in a virtual sense. It's not physical robots. These are trading robots. So this is just one of many charts that you can find. They're ubiquitous at this point, showing this upwards trajectory for algorithmic trading systems. So these are systems that sit connected to the markets 24/7. They're pre-programmed with algorithms developed by quantitative traders, often at hedge funds, but not always. And in many ways, they're a good deal smarter already than humans. They don't sleep. They think all the time about trends in the market. And by volume, in a number of the major world markets today, they are the majority of trading volumes. So this is an old chart. It only goes up to, I think, 2008. But it gives you a sense of what the upwards trajectory is. The volume in many markets is already dominated by robots. So it's sort of counterintuitive to think about all these 1950s, 1960s prognostications for where non-human artificial intelligence would come from, and then to find it in perhaps one of the most banal places in our world that you could find on financial markets. And yet this is, I think, the picture that's emerging, that AI is actually set in many ways to explode onto the financial markets. And I think it's worth thinking through the implications of that, especially in light of some recent trends in the financial markets. And one more point, I think it's worth noting that these AIs that are being developed to trade securities, derivatives, and so on, are in many ways a sort of alien intelligence relative to humans, certainly in terms of their physical parameters. They can act on very different timescales. So some of the faster markets have market movements on the timescale of milliseconds. This is much faster than a human would be able to think and process and react to changing conditions. And they're also geographically distributed. And so what I'll explore is this notion that not only is finance sort of the perfect petri dish for the evolution of superhuman artificial intelligence, but we can also, by looking at market structure, get some sense for what that AI may ultimately look like. It's another interesting thought. So let's take a look at what's going on in financial markets now. One of the single biggest macro trends is the consolidation of exchanges. This is happening for a variety of reasons. I don't think we'll ever consolidate down to a single exchange, but there are strong benefits to being able to localize transactions, not just within a single country or even a single city, but often, as is the case, to a single room. And the singular benefit there is latency. So if the market condition changes, you want to be able to react accordingly. If there's an opportunity to buy one item and sell another item, you want to be the first in the world to be aware of that opportunity. And the only way to accomplish that is by minimizing the time it takes for information to propagate from the market to you back to the market. And so, in fact, this is what we see. We see a number of major world exchanges. In 2008, there were about 50 or so major equities exchanges in the world, and that number is crashing right now. So I put up here a couple of examples for that phenomenon. And in particular, at the same time that these exchanges are consolidating in order to get traders physically closer to each other, we're also seeing intermarket latencies start to collapse. So I don't think we'll ever end up with a single world exchange where every financial transaction takes place. And if you take that as a working assumption, you can actually understand what's going on now. So some of the most expensive, some of the most amazing developments in networking technology now, and as well as networking infrastructure, are being driven by high-frequency trading and by the financial industry. So the example I showed to the left here, this is a route due to a company called Spread Networks, and they right now hold the speed limit. They hold the title for the lowest latency or shortest amount of time it takes to send bits from New York to Chicago. So their time is about 13 or so milliseconds round trip delay to send bits from New York to Chicago back to New York. And on the right, Hibernia Atlantic. So they're building a new cable underneath the Atlantic Ocean that will have a 60 millisecond round trip delay. Now, to put these numbers into perspective, let's take a look at what the physical limits are. So if you look at light propagated through an optical fiber, so you take into account its index of refraction, along a geodesic connecting New York and London, the physical limit to which information can be sent round trip for New York to Chicago is about 11 milliseconds. So they're already down to 13 milliseconds, and the physical limit is 11 milliseconds. New York to London, the physical limit is about 52 millisecond round trip delay, and they're going to be beneath 60 milliseconds. So it's sort of this incredible thought that finance of all industries is driving the development of this sort of fabric that we're wrapping our planet in. And on top of all of this, there's an enormous amount of innovation going on at either end of this pipe or this cable. So there are enormous developments in FPGA technology, ultra-fast signal processing at either end. Since the thinking goes, there is only a finite amount of development that can be done in order to optimize the round-trip signaling delay from a trader to a market back to a trader, or just between two markets. Both of these examples are low-latency pipes connecting to major markets. And so a lot of development and many dollars go into optimizing the speed of computer processing at either end, and that's driving technology forward. So it's natural to ask if this is one of the most important trends that's driving planetary scale computing and networking developments, and if you buy the concept that the financial industry is one of the most likely petri dishes for the development, the ultimate development of superhuman AI, it's natural to ask where this trend is going. If you extrapolate forward, you recognize that a lot more money can be thrown at developing the network infrastructure. Is this the end state, or can we do even better? So in a paper that I published with a colleague last year, I showed that it was possible to do better, much better in fact. And the answer to that question, I think, gives us a mental blueprint for what a financial AI could actually look like. So the first step is to recognize that in trying to answer the question of how we can do better than just shaving milliseconds off of these pipe latencies, is to recognize that finance, in a physical sense, finance no longer respects the concept of absolute simultaneity. So it's important to recognize that now we live in a globally distributed financial system where events happen on such short timescales that the timescales for that market structure are even short relative to the amount of time light takes to propagate around the planet. So if you go back here, so we're talking here about tens of milliseconds round-trip delays between major market centers, and market microstructure now happens in many places, on the timescale of a millisecond. So if you are not where the market is, if you're, say, in London and you're dealing with the New York market, the information that you're getting from the market can be quite stale if you're trading at high frequencies. And so this is, now that we recognize we can't respect absolute simultaneity at all, then you immediately have to start to think about finance in terms of special relativity. You have to recognize that you have events that take place in space-time, not just in time. Space is an important factor, and that information propagates at a finite speed. And so you have to start to think about trading as a space-time process. So this is a sort of cartoon schematic of what one of the most important trading classes will look like. So this is arbitrage. You have two items, two securities, two derivatives, whose pricing behaviors have historically been correlated. So when one goes up, another typically goes up as well. When it goes down, the other one has historically gone down. But often there will be local noise, local jitter in the pricing that will cause two correlated securities to diverge. So one will go up for a short amount of time relative to the other, one of them will go down relative to the other, it doesn't really matter. And so this brief divergence is an opportunity to capture profit. If they've been historically correlated and you believe that they're going to become correlated again once more, then you believe that eventually they'll revert to the mean. And if you know that's going to happen ahead of time, then of course this is an opportunity to arbitrage using your knowledge. So you know ahead of time that you want to sell the one that's going to fall back and buy the one that's going to rise. And this is a very common sort of financial transaction. Statistical arbitrage in general is one of 3 or 4 important classes of transactions. But I think it's the most natural way to visualize this notion of the near to intermediate future of finance. So what we're seeing here are 2 security prices. So one at location X, one at location Y. In particular, once we have this notion of 2 prices, again shown on either side of the diagram, that are historically correlated but can diverge on very short time scales, then we can visualize this process as follows. So starting at time minus tau, we have a pricing update. This is, we're going to assume that these markets are co-moving. We have 2 pricing updates, one from either side of a pipe, probably fiber optic pipe. And these pricing updates are sent at the speed of light, almost, as measured by the optical medium, to each other. And then trading orders can be issued at either side of the pipe. Remember, we're doing an arbitrage transaction here, so the buying and selling of the 2 items on either side of the pipe needs to be coordinated. And then these execution instructions are sent back to the original site so that knowledge of the transaction that happened can be recorded. So this is the way things are done right now. And from the point of view of pre-coordinated systems, it actually works reasonably well. So you can put 2 pre-coordinated software systems at either end, say one in New York and one in London, and you can arrange in advance for them to obey certain market conditions and for them to coordinate their buying and selling transactions such that at the end of the day when you unwind your trades, so when you buy the low and sell the high, that you're able ultimately to unwind those and make your profit. And it's incredibly important to try to maintain a net neutral position because markets can fluctuate wildly and you don't want to be surprised by holding a large position, either positive or negative. It hurts your ability to do this trade overall. So the question is, can you do better than this? The answer that I published last year is yes. And this is what it looks like. So rather than pre-coordinating trading on either end of a pipe, instead locate the physically perfect position in between those 2 locations for coordinating trading. And it's sort of remarkable that this solution had not been published previously, but as I'll show, it's a completely universal solution and actually intuitively makes quite a good deal of sense. So it turns out that you can do a much better job, potentially have a 50% reduction in latency rather than just skimming off milliseconds or even hundreds of microseconds at either end by positioning a server that's physically or geographically in between the 2 markets that you want to trade on. And so what I'll walk you through is a quick derivation of that solution. And I think the logic will become apparent. So symmetry will no longer be preserved, And in particular, we'll now have a single geographic location from which to not only coordinate, but also to preserve a net neutral position. So I'll go into a bit of the formalism here. So we can think, as is often done in finance, about Basel-check processes. So a Basel-check process is, to put it simply, a reversion to mean process combined with a noise process. So the system, in this case, security price, will ultimately over time be forced back to a mean. In this case, for simplicity, we'll choose that mean to be 0. But over short time scales, it's driven by white noise. And that can cause it to fluctuate away from this mean. And so this is a really nice, simple formalism that allows us to capture most of the important dynamics of correlated securities prices. In particular, when we want to think about two correlated securities, we can consider two Basel-check processes, each of which is reverting to the same mean, but each of which has its own independent noise source driving it. So the physical way to visualize this is if you have a trading system in New York and a trading system in London, then each of those trading systems will, on very short time scales, so time scale of, say, a millisecond, have access to unique information that's independent of the millisecond time scale information that the other has. So there are a variety of signals that these trading systems use. It could be the weather, could be access to corporate filing that was just made available on one side but not the other. But functionally, you can think of these noise sources for the purpose of this derivation as being independent from each other on very short time scales. And so this formalism is enough to actually go ahead and solve the problem of where, if you're trying to coordinate buying and selling in two physically different areas, where should you position yourself? So under a few conditions without loss of generality, it's possible to actually go and derive what the expected ratio between the prices on either side is going to be. And in particular, we can derive where the optimal ratio of prices on either side of the pipe is going to be in order to maximize profit in terms of the spread at the time of the order execution. So after running through the formalism, we arrive at a general solution, which is not a function, and it's important to note this, it's not a function of geography, it's a function of latency. So this solution is actually completely independent of where we either presently or in the future decide to lay optical fibers connecting cities and exchanges. It's purely a function of the latency connecting your coordination server to either exchange. And it consists of two terms. The term to the left is a function of the mean reversion rates on either side. So this is sort of a general fixed constant term. And the term on the right is a function of the instantaneous behavior of the securities that you're trading. So both the prices and the price velocities are important in determining the second term. So let's ask ourselves, as we have to do when looking at optimal solutions, when there even is an optimal solution in the first place. In other words, when does it make sense to actually position yourself in between two markets, physically or geographically in between two markets, in order to coordinate trade? So this is a derivation of the conditions for optimality. In particular, it's possible to show that under, again, simplifying conditions over short time scales, you can model pricing movements as quadratics over a short time scale, that quite a general frequency range, a broad frequency range, supports this sort of optimality. In particular, the frequency of fluctuations that support the profitable arbitrage, or the profitable arbitrage coordination from a site that is physically or geographically in between or intermediate to two sites, is bounded at the lower end by the frequency that corresponds to the reversion rates of the market, which is quite a small frequency. And at the high end, by the the time scale required to send information from one market to another. So a number of more modern markets, including several in New York, actually meet this pretty broad criterion. And so it's possible, now that we know the conditions for optimality, to ask ourselves where these points are. So this is the map that we published last year. So I think it's pretty interesting, even if a number of toy model assumptions go into it. It's a sort of treasure map for novel geographic opportunities for financial transactions. So the large red dots here correspond to the 50 or so largest equities exchanges as of 2008. Some are obviously much larger than others, but they're all recognized equities exchanges transacting various volumes. And the blue dots correspond to these optimal locations under simplifying assumptions. So for every pair of red dots, we can see a small blue dot here that corresponds to the optimal place along the geodesic connecting those two red dots for coordinating trading on those two exchanges. And the more general formalism here, as you can see, turns out that the optimal location is a weighted average of the mean reversion rates on either side, which could be parameterized in a number of ways. So a couple of observations. First is many of these points are in the ocean. And that's I think, pretty unique as an observation, since we've exploited our oceans for the past several decades for many other major industries. So the intersection of ocean development and energy is quite well understood now. The innovation that's happening in the financial sector could very well end up spilling over into ocean development now. And you're starting to see the beginning of that, and I'll talk a bit more about that in a few slides. But the notion that finance has the potential to propel ocean development, even ocean colonization, is still a pretty new concept. But this general formalism, I think, has the potential to push that forward. Another, I think, sort of interesting notion that falls out of this picture is right now the most financially valuable land is perceived to be the land in proximity to the major financial exchanges. But what we're seeing here, in fact, is that it's possible that geography could become a new sort of natural resource where you don't have to be proximal to the actual location where trade is happening. In fact, it's perfectly sufficient to be somewhere far away from two trading locations as long as you're well positioned to one of these nodes that I derived earlier. And the notion that geography could become a new sort of natural resource that could be mined by countries that right now are quite network sparse and are still developing is, I think, a pretty interesting concept also. That in addition to, say, mineral natural resources, simple geographic distance from two well-established, developed areas could become a new sort of natural resource that could be exploited. And from an artificial intelligence point of view, you can also start to get a picture here that is, I think, the beginning of an answer to the first question that I asked earlier. What would a superhuman artificial intelligence look like? Well, this may be perhaps a sort of sketch of what one might expect, namely that you push so many AIs onto the financial space, inevitably you're incentivizing the creation of latency mitigation measures, which then cause the distribution of computation, both networked and just raw computational ability around the Earth's surface. So we're talking about timescales that are much faster than normal timescales for human thought. That perhaps was recognized in the sci-fi descriptions from the 50s and 60s, and people have come to expect that. But what's new here is these AIs could also become geographically distributed. In other words, they're going to be much larger on a functional basis than a human mind. And I think that's a somewhat new thought. Moreover, if we want to push this analysis to its logical conclusion, we can ask, what happens if we're not just considering intermediate points for a given pair of instantaneous prices and price velocities? What happens if we want to derive not just this sort of specific special solution, but the most general solution possible. In other words, what would happen if we tried to sort of create a heat map for distributing coordination servers all around the Earth's surface to handle all possible contingencies for arbitrage opportunities? So it turns out that it's possible to do that. And the implications here are, again, I think pretty interesting. So with a sufficient density of coordination servers, it's possible to model the propagation of pricing information as one would an electromagnetic wave. It's possible to derive a wave equation for the propagation of financially useful information in or through a medium that's able to act on it. And to my knowledge, this is the first example of sort of financial optics. The intersection of finance and optics, you can think about a medium corresponding to a dielectric medium in E&M, consisting of an array of computers that are listening to pricing and financial information that's coming in and have the ability to act based upon that information. So for those of you in the physics world, you'll think of arbitrage or an arbitrage server as something resembling a dielectric moment. And it's possible to actually develop a system of optics based on finance and financial arbitrage. So the top equation here is a wave equation for the propagation of financially useful and exploitable information traveling through an arbitrage medium. The wave propagation is dispersive, as indicated by the second equation. And then, most interestingly, we can work from the dispersion relation to examine the behavior of the propagation of financially useful information through, at a number of different fluctuation frequencies, through arbitrage media. And the answers are pretty interesting, and the sort of dictionary of terms that you can create between finance and physical optics has some interesting implications. For example, the first row here takes place at low fluctuation frequencies. So frequencies that take place at shorter time scales, that correspond to shorter time scales than the ability for these arbitrage servers that they're passing through to go and exploit them. Correspondingly, there's very little exploitable information that is propagating, and this medium, this financial medium, we can consider to be transparent to the propagation of information. We can also derive phase and group velocities corresponding, again, to standard wave physics. But at higher frequencies, so at frequencies, these are again fluctuation frequencies corresponding to numbers that are higher than these reversion rates, something really interesting happens, which is that the medium that these waves are propagating through becomes opaque. And this is sort of a remarkable concept if you think about it, that the notion that a network could become opaque to the information that you're trying to transmit through it. The network should be completely transparent. How is this possible? And an analogy I like to use to understand this is think about a game of telephone where you have a bit of information, you call your friend, and you need to pass this information with high fidelity down the telephone line past n friends, and you read it out at the end. So the servers here correspond to the telephone line, but the information here is financially actionable. So to work with this analogy, let's think about playing a game of telephone with the key combination to a safe that contains a lot of money. So you start the game of telephone, that key combination gets passed down, but pretty soon someone in this game of telephone runs off to the safe, uses the combo, and extracts the money. And they'll continue to pass down the combo to the safe. That information will actually propagate, but its utility has now disappeared. So if you think not just about financial information, which is the normal mode of thought, but you actually think about financially useful information as a physical resource, then you find, again, here's the formalism, that the medium through which you're trying to send that information, as long as points within that medium have the opportunity to act upon that information, actually becomes opaque at higher frequencies. So here again is another sort of nifty example of tying together the physical and digital worlds in the financial industry. And from a computational and an AI point of view, we can start to find, it's quite possible in the next few decades, that all of these assumptions that we implicitly held about the ability of networks to pass around information and about the physics of information flow turn out to be somewhat pliable. And if we just look at what's happening right now, this is a map from a couple of years ago showing all the major fiber cables that are laid or are being laid. And you can again see this notion that we're in the process of building out a fabric around our planet. The fabric's leading edge application, its killer app, is, and it appears is going to be for many years to come, high frequency trading and finance. And as this fabric gets built out, I expect that it will have applications in a variety of other sectors, but the key driver right now is the ability to trade at a profit in very short amounts of time, and this build out will continue. So I think this is an answer, if only partial, to the first question that I posed at the beginning of the talk. And now I'll talk a little bit about the second question. So we have a picture in our minds now about what these AIs may or might look like. The question now is, can we learn anything from this picture in terms of managing the development of AI? And I claim that we can. In fact, just as I established earlier a dictionary for converting language that deals with physical optics to finance, I think it's also possible to establish a dictionary between finance from a regulatory point of view and AI regulation. And I think we can look to a lot of recent developments in quantitative finance as a blueprint for how we'll ultimately deal with the rise of artificial intelligence and superhuman artificial intelligence. So let's take a look at building out this dictionary. So this is a sort of interesting proposal that has been floated by the CFTC here. So this is pre-trade testing of algorithms. It hasn't been implemented yet, but there's been a lot of discussion in regulatory circles about requiring that hedge funds operating these algorithmic trading systems actually test their algorithms, which in practical terms means exposing their trading strategy to regulators. This sort of thought was perhaps unconscionable about 10 years ago or so, but now there are very serious suggestions of doing this. And in terms of managing the development of artificial intelligence, and there are many people who think about the sort of existential risks of artificial intelligence quite a bit. And there are many people who fear that artificial intelligence, because it is very difficult to confine, because in principle it could be built someday in somebody's basement, would be a very difficult thing to regulate. And what I claim here is, in fact, we already have the blueprint for what regulation of artificial intelligence would look like. There are many other existential threats that we face. We faced nuclear existential threats, and the ultimate outcome of having agencies that regulate nuclear energy and weapons, I think, is perhaps instructive, but not as instructive as taking a look at the financial space, where we're already building out systems that are physically faster than humans and on a nice track to exceed humans in terms of general capacity. So the CFTC suggestion of building out pre-trade testing systems, I think roughly corresponds to the creation of source code audits. Now these could be binary audits, they could be source code audits, but in general, having this notion of having a single regulatory authority that is required to audit the behavior, audit the source code of AIs that are under development, right now seems like a pretty silly idea, but we might want to reconsider it in a few decades as we continue to emerge from the AI winter and as the technology continues to get better. The next notion, dark pools. So dark pools have grown quite radically in popularity in the financial community. The essential idea here is that if you are a retail investor, as many of you may be, or if you are just an investment bank that doesn't control the trading venue, then you are always left open to the problematic situation of front running where you say want to buy 10,000 shares of a company and you issue that order, but before your order is executed, other participants in the market have figured out that you're going to order it, they buy before you, they front run you, and now they're the ones selling you those instruments that you wanted, and they're collecting a profit off of foreknowledge of your actions, even though you simply wanted to go immediately to the market and execute your trade. So it's another example of the importance of latency, and in some major markets now, there are actually rules and rulers for making sure that market participants are physically spaced at equal lengths from the trading core to make sure that front running is mitigated as a problem. And so beyond evening out these length scales, dark pools have emerged as another popular solution. So the idea behind dark pools is that rather than having a transparent market where prices can be seen transparently and where actions can be deduced transparently, instead you create an opaque layer over the market where the participants, who hopefully are unique entities from the operator of the market, can't see what each other are doing. And as a result, the opportunity to front-run transactions is mitigated. So basically, they trade somewhat blindly regarding each other's actions. And this has the effect of leveling the playing field so that if you have a faster trading engine or a faster connection, then you can't fully take advantage of that as you could under normal circumstances. And I would postulate that this innovation, if you want to call it that, of dark pools in the financial industry corresponds roughly, for those of you who are familiar with Werner Vinge's writings, to his concept of zones of thought. So we could, for example, go about creating economic zones. We already have special economic zones right now for leveling the playing field in a regulatory sense in developing countries. This notion of charter cities. So what I claim is that we could apply this notion of dark pools to intelligence in general and create economic zones where we artificially level the playing field between AIs and human players. And we're already doing this right now in the financial space. So it would be, I think, a logical extension to think about ways we could generalize it to non-financial activities. So this is a rule that the SEC passed back in July. This is the large trader rule. And the idea here is that if you operate a hedge fund or other trading entity that trades over a certain volume or a certain dollar amount in a given year, you're required to register not only your hedge fund with the SEC or one of its sub-agencies, but you're actually required to register the entire org chart for everyone who touches the hedge fund. And I think this is quite an obvious blueprint for what we could do with AI in general, that at some point, I suspect, we'll have a central AI regulatory agency. Every AI above a certain level of intelligence or capacity will be registered with a central agency, and then the central agency will have all the social security numbers for all the humans that are in direct contact with it, so that when something goes wrong, we know whom to blame. Here's another example. So for those of you who remember the somewhat recent now flash crash, market circuit breakers have emerged in some cases quite forcefully from a regulatory point of view as a solution to errant behavior by trading robots. Now you can debate the merits of market circuit breakers. Some people within the financial community feel that circuit breakers can, at least some of the more recent ones, can be somewhat onerous. But in general, the idea that if automated systems, and it is largely automated systems at this point, that automated systems, if they go wrong, we should have the ability to pull the plug on all of their interactions. And I think that generalizes quite naturally also to saying it should be possible in principle to have a unified and centralized plug pulling on the AIs that get built out in analogy to market circuit breakers. So this was another one that was due to Dodd-Frank. Swap data repositories This is the notion that, again, for certain classes of transactions with certain market players, you record every transaction that's being transactioned for later analysis. So again, this notion of sort of black box for the markets. And I think this notion generalizes naturally to recording all the activity that AI may be performing so that, again, you can go back later and find out what, if anything, has gone wrong. Now, here's a pretty controversial measure that the EC had proposed, which is imposing either a short-term capital gains tax, a new one, or a fee on high-frequency trading or short-term trading. Many people in the financial community feel that this especially is an onerous measure, but I think it's also possible to view it as a blueprint for how we might deal with systems such as the one that I described earlier, that are able to think on timescales that are much faster than our brains and on length scales that are much larger than our brains. And that in particular, we might want to actually, is the term in economics, tax the machines. In particular, we might want to impose short-term capital gains fees or short-term transaction fees on these robots that are engaging in finance. And this could emerge as either a taxation of their interaction with the physical environment or simply taxing their bandwidth with the physical environment. So the big picture that I'd like to communicate here is, without realizing it, not only are we in the process of building this extraordinary fabric of computation around our planet, on our planet's surface, in order to service financial intelligence, but we're also, again, perhaps unwittingly, developing the system of regulation that we may ultimately want to use to make sure that these AIs don't fully decouple from our own human civilization and intelligence and economy. So with that, I will take questions.
We do have time for questions. Because it is hard to hear in this room when you're asking your question, if you would please stand and speak up.
I have two questions. First, since this is mostly AIs that are doing the trading, your comment at the beginning about how we want to understand human actions to predict the market. That's totally irrelevant. What you really want to do is understand how your competitive systems are working, which means espionage or perhaps some clandestine stimulus and looking at the response to market. And does that suddenly become just a game of criminal activity? That's question number one.
Well, let's answer the first question. I think that's an excellent question. The way I would answer that is to recognize that once we live in a market whose activity is totally dominated by robots, then part of success for the robots involves developing a form of social intelligence where they need to have theories of mind for their competing traders. And so now, instead of modeling human minds, they're modeling their own group collective minds. And I think there's the potential there for also the development of superhuman intelligence motivated by financial and social intelligence.
But we're also talking about espionage and other underhanded type stuff. But second question is, with a system like this, why would you expect stability? Why would you expect anything to ever revert to the mean?
It's a valid question. So I guess there are a few ways of answering that. Things don't have to revert to any mean on long time scales. There doesn't have to be a mean on long time scales. There does have to be a mean on short time scales because eventually information becomes evenly distributed. And as a result of even distribution of information, sorry?
Not necessarily, because things are, you said it becomes not transparent anymore, it becomes opaque. So the stuff may actually not ever get out.
So the systems that become opaque happen as a result, as I mentioned, of the limit of physical density. If we consider the low density limit, then information does eventually become available to everyone. And in that contingency, in that limit, information, when it's available to all players, will cause price reversion. But as you mentioned, when the system is opaque, or in the case, for example, of dark pools, we don't have to have any reversion at all. You're correct. Yes?
What are you noticing about fluctuations and their impact on predictability or phenomena? Are you seeing some correlations?
Fluctuations in terms of?
Pricing models, activity, volume, things like that. In other words, any kind of fluctuations that you can measure. Are you finding any sort of correlation length phenomena? Are you finding phase transit?
Oh, I see what you're saying.
Modeling type?
Yeah. So this is a well-studied area in finance. So the issue, for example, of phase transitions in markets has been studied to death. This is not an area that I've focused my studies on, but I'm familiar with the literature. And there has been quite a bit on phase transitions in general, classical phase transitions in the markets, risk on, risk off, that sort of thing. It's an active area of study. Yes?
This is, I suppose, should be a question of how would you prevent this artificial intelligence idea or program from becoming a no-fault insurance war game used by espionage agents?
Could you repeat her question?
So the question, as I understand it, was how do you prevent what is the financial system bred in tooth and claw from descending, if I understand your question correctly, into espionage and sort of military activities? Does that capture your question?
Terrorist war game.
Or terrorist war games?
Where nobody is at fault.
So, in some sense, you could say that there are no hard barriers to that happening. It depends on what you consider, sort of how you scope the financial markets under consideration. If you scope in scarce resources or scarce political opportunities, then you could very well say that the system has already descended into terrorist war games. It's sort of a scoping question, where how do you decide which markets you're including and which activities you consider to be normal market actions versus externalities that impact all the players. Yes.
Yeah, as you move past two trading centers to find your optimally geographic location for trading, does your solution become non-holonomic? And if so, how do you go about finding the ideal solution for multiple trading centers?
That's a fantastic question. So for the simplified case that I showed, there is always an optimal solution, and it's a weighted average of the multiple positions. For the general case where you actually want to take in prices and price velocities, there is not guaranteed to be a solution at all. So this is, in its most general analysis, this only works with two markets, and the problem becomes over-constrained if you consider more than two markets in general. Yes?
You mentioned a case of where information is sent from one location to the other, but it can be intercepted, and so it's, even though it still gets through, the utility of it is destroyed.
That's right.
How have you thought about using quantum methods of transmitting information so that if an interceptor grabs it, it's known?
It's an interesting question. So if you're asking about the implications of quantum communication for this. To be honest, I haven't studied the quantum aspects of this system, but it's an interesting notion that you could avoid the classical dispersion effect by using a quantum channel. Yes.
I try to get this. In the first place, I'm trying to get to the fundamental assumptions you're making. First, you could have obviously economies where you didn't have a market. I mean, you could have a planned economy, you could have command economy, fixed prices. So the question is, the market itself is not inherently connected to an economy. That's why they come up with this term market economy. All right,
Yep.
so then the question becomes, if you have an argument, why should we have a market economy versus some other type of economy that is possible? Usually the argument is, well, the market economy has shown all sorts of dynamism or whatever,
Right.
plus makes people filthy rich, but leave that aside. But anyway, various arguments. And then the second line of thought here. I once had a friend who dabbled for years, made some money in, I guess you call it technical analysis. These are the people who just study the charts and say, I don't want to know about the fundamentals. I never want to read a corporate report. And of course, then the argument there is there's some kind of psychology of the market, and somehow what they're really doing is sort of understanding mob psychology or panics or so forth and so on. Whether that works or not, people make money on it. So then some people say, well, that's ridiculous. I mean, what are these people doing? They don't even pay attention to the real economy in terms of the fundamentals.
Right.
But the argument in favor of it is that the whole, this is my fundamental point, and I'm just asking whether this is what you do, the concept of the market as opposed to some other concept. The market is a system which, played by the rules of the market, absorbs every possible piece of information that people feel they have about the future,
Right.
to the extent they're willing to put their money on it. And then putting the money on it is a pretty good test of whether you really think that's what's going to happen. So the fact that the mob psychology, so to speak, or whatever you call it, psychology of groups of the market gets factored in by people who don't even pay attention to the fundamentals of the physical economy. Nevertheless, that is information about the future, and so they're actually doing exactly what the market should do, because they're factoring in that possible knowledge of the future. So essentially, the future becomes...
Is there a question here?
Yeah.
Okay.
Is that his definition of what the market is, in terms of a system that coalesces all possible information about the future, tries to factor it out? Is that what your understanding of the market is?
the formal-
You never defined what the market is.
Right. So the formal analysis that I used actually didn't build in especially strong assumptions regarding what a market is. I'm considering purely time series behavior that's geographically distributed, that has certain noisy properties and certain reversion properties. And in principle, this analysis could be applied to almost any activity that has those pretty general characteristics. For example, you could apply the analysis to, say, a geographically distributed video game where you have two players that are on opposite sides of the world that are reacting to similar things in their environment, but there's a latency, and they're interacting with each other in some way in order to maximize some other quantity. Maybe it's not profit, maybe it's video game points. So it's a pretty general analysis. And in terms of your question, if I understand it, this maps most naturally onto the sort of market that consists of people playing with time series analysis rather than looking, at least over short time scales, rather than looking at fundamentals, except where reversion is concerned. And I'd say this concept of reversion is the one area where the concept of this distribution of information, ultimately based on whatever fundamentals are out there, is built into the model. Yes? Oh yeah, I'm sorry, in front.
Yeah, I had a question on, if you had a spline model that had 2 points that were not no point midpoint, but 2 points 1/3, and they were able to communicate with each other and communicate with those markets, wouldn't that be a faster solution?
Yes, not a faster, but more effective solution.
More effective, yeah.
And that is why, if you want to read the full paper, you can see a deeper analysis. But that's why we're considering the ultimate case where we not just have you don't just have a single trading server on a geodesic connecting to exchanges, but you literally string densely a bunch of servers all along that. And it turns out that in the limiting case, that the sparse case is difficult to determine analytically, but in the limiting case that you have dense servers all along this, it turns out you actually get something resembling wave optics happening. I'll wave back over there.
Assuming that this becomes the general system used throughout the world, what would be the 3 worst social consequences? None is not an acceptable answer.
Well, I think the single worst social consequence, It's not just this notion of distributing HFT to its logical conclusion, but the single worst scenario that we should be concerned about is having the AIs, whether they're financial or more general, economically decoupled from human welfare. So we have this is a well-studied problem in international economics, where you have some countries or blocks that economically decouple from other areas of the world. And this is problematic if you're poor, because you ideally want to have your own welfare, your own quality of life coupled to the wealthier areas so that you get brought up through trade. And the single worst, short of all the obviously existential nightmares that many people have discussed previously, I think the more banal nightmare is that these systems evolve such that they dominate all the relevant capital or resources, and that they decouple from human labor. And perhaps we see the beginnings of this with systems that already are in command of large amounts, quantitative finance systems that command large amounts of capital, but whose behavior has arguably in certain cases been largely decoupled from what's generally perceived as human welfare. So I think the big picture is decoupling. We want to avoid decoupling however possible. It's right here.
Quantitatively, in terms of speed, this is obviously a new problem with AI. But is this really a new problem? Aren't there analogs before there were AI? I mean, because people needed certain places, because they needed Israel because it was right between two different civilizations, and for no other reason, as far as I can figure out. Just it's right there.
Right, or perhaps more generally, the development of Western-Eastern trading routes and being well positioned along that corridor. Yeah, so in some sense, this is sort of the high-tech 21st century evolution of these trading corridors. The difference is humans were in control of those trading corridors, and these trading corridors are run by robots.
But the people,
and they're a good deal faster.
But wouldn't you say that the people under those historic conditions were in control? They were acting like a little bit like robots because they were sort of. It's
a good question. I mean, you could sort of ask, what is the role of the invisible hand in an economy that's largely consisting of software agents? Or, are these software agents acting as the invisible hand? If they're highly efficient, then it's not obvious whether there is a meaningful distinction to be made there. But I think your point is well made that what we're discussing here is in many ways an evolution of these trading corridors that have existed for centuries. The difference is now, A, they're largely out of direct human control, and B, they can be anywhere. The trading corridors, arguably the largest ones, were bipolar. There were some pretty coarse geographic trends there, whereas here, this enables the emergence of thousands of trading corridors, if not millions, or the equivalents of many trading corridors.
Two more questions?
Just a quick comment. I'm not sure if you folks gamble, if you're aware of the gambling community. They just started predicting the probability to the nth percentile of sports statistics in Las Vegas as a result of having done all the calculations of the consistencies in behavior and ability to manipulate people in the blue screen. The fact is that you might want to know that the stock market signals in the gambling and narcotics trafficking community consistently. Trafficking signals, trafficking payments, and all these other signals connected to sports gambling. So if you were to choose a model, I would hope that it would not be the stock market model. The model's based on profit from short-term gains.
Okay. Noted. Yes?
Alex, very interesting theory here. If I try and apply this to the event of the week, perhaps, a situation that was front-page headlines in most of the major finance journals, it was a judge in the Southern District of New York saying that Citigroup's settlement with the SEC was inappropriate and he rejected it. And what happened in that transaction, reduced to the simplest model, is there was an arbitrage with a reversion of the mean between bonds, mortgage-backed security bonds that Citigroup, like Goldman and many others, thought were going to crater at some point soon, and credit default swaps, which were a wonderfully opaque market.
Right.
So you put the first asset out through the Cayman Islands, it's semi-opaque, but you keep hidden the second one. It's in not milliseconds. It took maybe 3 weeks from the conception and the modeling to the deal execution. Because it was synthetic, you don't even have to move securities around in that money. It took less than 5 months for $700 million to disappear from the investors as a loss, and $130 million to be credited as a gain to Citigroup. Then it took 3 years for the regulators to find out what happened and assess a minor fee. Now, in this case, it was the SEC, it wasn't Commodity Futures Trading Corp, but the SEC has no authority over the credit default swap market, so they barely even understood the phenomenon. The reason I mention this is I'm trying to envision auditing source code for Wall Street arbitrage funds. It's a really fascinating concept, but I don't know that in my lifetime we'll ever see Dodd-Frank evolve in that direction. But I think it's a very good concept that evolves out of your model. And I wonder whether you think this model has other implications for this issue of the day.
No, it's an excellent point. And at this point, this is just a CFTC idea that is perhaps nowhere close to being implemented for the obvious reasons you identified. That said, I think it has to be put on the table because ultimately source code security is one of the few ways. It's not a guarantee. You can always obscure some malintent in any code, but it's one of the stronger antidotes that we have to this sort of behavior. It's not perfect. So
One
more
last question.
So I have a question. As markets become more highly automated, and an say an institution is creating like machine learning algorithms, for example, and those algorithms are producing numerical models which are based on the behavior of other machine learning algorithms and other similar AI. Does that introduce a very dangerous nonlinearity if you have a system of like all of these different institutions that are creating numerical models based on each other's behavior? Could that, it seems to me like that has a recipe for some sort of chaotic behavior.
Absolutely. Well, more than chaotic, it can diverge. And so
that's a reasonable
absolutely. Right. So at some point, if you throw enough systems at the market that don't care about fundamentals and are designed for short-term profit only, then at short time scales, fundamentals effectively don't matter anyway. And so you can see wild swings in the market that are purely the result of these social interactions between trading algorithms. So I think that answers the question.
Thank you very much. And as a token of our appreciation, we would like to present to you a copy of your lecture announcement, which has been framed and signed by all the members of the General Committee. Thank you very much.